In this presentation, we will continue on with part 22 of our C Corporation Comprehensive Problem, this time taking a look at the computation of the cost of goods sold, which can be found on the Form 1125A. Here is our Form 1120. What we're going to be concentrating in on here on the first page of the 1120 is the cost of goods sold calculation. Not this one, but the cost of goods sold calculation. That's going to be line 2. Notice it says that we have to attach the Form 1125A. 1125A is here, gives us the detail of the cost of goods sold calculation. Now, when we entered the cost of goods sold as we first started the problem here, we wanted to enter it just as it was on the income statement. So if I jump over to our Excel worksheet, we see that we have the cost of goods sold in the data input of the income statement at this amount, and then we had to make an adjustment for the depreciation that was included in part of it. And therefore, we started out, when we put this number in here, just basically making whatever the beginning and ending balance of the ending inventory the same. And if you're dealing with just basically purchasing and that's it, you're not making or manufacturing, then as long as you have the first number of the formula as the same as the ending inventory of the formula, then whatever you put into purchases will basically be the cost of goods sold. We started with that because our focus at the beginning was to get to the net income on a book basis, and not try to deviate from that and go into other type of areas such as the cost of goods sold calculation. So now we're going to go back in and take a look at the cost of goods sold calculation. So let's just consider the cost of goods sold calculation first. If I scroll back down and we just get some room down here and put in the cost of goods sold. Now typically the cost of goods sold calculation would be the beginning inventory plus purchases, and we typically might have a subtotal. If I spell this wrong, I apologize. That might be called goods available for sale. I can fix that one. So I saw that one, so I'll fix it. And then minus ending inventory. Inventory. And that's going to give us the cost of goods sold. That's typically our calculation. Now note that if you're talking about a company that makes the goods, then you don't have purchases, you have cost of goods manufactured. I'll abbreviate it like that. Looks very similar to the cost of goods sold, but no, it's the cost of goods manufactured. So I'm not going to get into the details of the cost of goods manufactured calculation because they can get a bit more detailed. We have a course on manufacturing companies and the bookkeeping related to it. But just note that, of course, the cost of goods sold, the cost of goods manufactured is going to typically include the labor that was included in manufacturing the goods, the material, of course, the materials that are going to be used in it, and then the overhead. So that's often what's going to be included in there. So again, I'm not going to get into that in much detail in terms of what kind of things would be included. That's more of a bookkeeping type of thing. Just note that when you're thinking about the cost of goods sold calculation between someone that just buys and sells merchandise versus a manufacturer, you have a bit of a difference there. So what we're going to do is we're going to say, all right, we're going to start with the beginning inventory. So we have the beginning inventory up top, and I'm going to pull that from the financial statements in the prior time period, or you can pull it from the tax return for the prior time period. So the inventory was at $1,440,000. So that's a known number. Then we have the purchases or cost of goods manufactured. That may be the number that we don't know, right? That might be the one that we don't know. And again, if it's a manufacturing company, we're saying that we did some manufacturing because the depreciation was calculated in there. Because we want to give an example, depreciation could be a part of overhead that might be included in there. So we don't really know this number. We know that this number is going to be the sum of these two because it's a subtotal. That's how much we would have then available. So equals the sum of these two. And then we know what the ending inventory is because that is on our ending statement. And that would probably coincide to a physical count that they took, right, and verified it. So we're going to say there's the ending inventory. We know that. And then the cost of goods sold would be calculated as the goods available for sale minus the ending inventory. So we would expect it to be the subtraction, but this number we don't know because this is an unknown. So I'm going to say, all right, that's the unknown. But I do know what's on the income statement. So if they did the bookkeeping correctly, you would think the ending inventory would be what we find on the income statement, which is this number, cost of goods sold. So notice that we picked up, or I picked up, the wrong number. I picked up this number, which is the beginning number, but we then adjusted it for the tax purposes. So we really need the tax number, which is this 969895. So I'm going to keep going forward with this number because it's going to, of course, throw off our calculation. We're going to actually input that into the tax return, then see that our tax return will not be in balance, so we'll be able to catch the error. At that point in time, we're going to go back in and adjust that. If you want to avoid that, you can just use this number, but I do want to show how that process would work. This is a common kind of thing, and when there's a problem, it will just bounce back to where we were prior to the problem, rather than having to go back any further and then adjust the return using, of course, the double entry accounting system being applied to the tax return. Therefore, we have all the tools we need then to do the calculation and figure out what this number is. Now, we could do it with basically algebra and just write this out and figure out the algebra. I'm going to use a format just to show you a nice little tool in Excel if you have all this calculated out the way you want to see it. So to use that, what I'm going to do is I'm going to go over here. I'm going to say I know that cost of goods sold should be 917024. Then I'm going to put the correct formula in here. What we think the formula for cost of goods sold should be this minus the ending inventory. Goods available for sale minus the ending inventory. So we have all the formulas in there. This number's wrong because we don't know this number, but all the formulas are in place. Then we could use this what we call the goal seek, or it's called the goal seek formula in Excel to kind of figure out what that number will be. And this can work in pretty complex kind of systems as well. As long as everything is connected, you could say, all right, well, what does that number have to be in order to get the result that we want? So let's see how Excel, this nice little tool in Excel, can help us with that. So we're going to go to the formulas. Actually, it's going to be in data. So it's in the data. It's in forecasting. I'm going to use the what if analysis. We're going to go to the goal seek. So goal seek in Excel. And again, you can do this algebraically here if you don't have Excel. Just a little tool within Excel that I think is worth looking into. So notice I'm not on any of these cells. I'm just somewhere else, right? I'm just anywhere else. And then I'm going to be solving for what this cell needs to be in order for that cell to be what we think it should be. So to tell Excel, to ask Excel this, we're going to say, all right, please set this cell to be what we think it should be, which is, I'm going to hard code this, 917024. I want that cell to be that number by changing this cell. And they're all connected, so you should know what to do. So in other words, set the cell, we want to set this cell, which has a formula in it, which is connected to the cells above it. Set that cell to be this hard-coded number by changing the yellow cell. And it'll just basically test every number out until it figures out the number that it needs. So we're going to say, all right, do that. And then it tests every number out until it gets to this 1,127,24. So that's the number we're going to use. Does that make sense? If we reset this calculation, it would be, this. Well, the subtotal would be this equals this minus this. Equals this plus this. That would give us the cost of goods available for sale minus the ending inventory, which is, we're going to say that number. And if I subtract those two out, do I get to the proper number? Yeah, so that looks good. So now we're going to say that the purchases is this number. Now notice we had some manufacturing in there because we allocated the depreciation there because I wanted to show the allocation of the depreciation. So we're basically going to say part of the purchases or part of the cost of goods manufactured. Then we're gonna go back to our 1120 and take a look at the depreciation is going to be that 288585. So I'm gonna say the depreciation is going to be the 288585. And so the difference then between the purchases and that number we're going to put into purchases. And so that's what we have there. So let's see what this will look like then. I'm going to format this like that. There we go. All right, so let's see what that'll look like. If we go to our tax return, we're then going to go back into this number. We got to fix the beginning number. Here's our beginning inventory. We fix the ending inventory. and then we're going to put our purchases in there, and our depreciation is being calculated for us as it's being pulled from the depreciation schedules. And again, we're assuming here, we're saying that depreciation is part of the manufacturing process of inventory and therefore part of overhead and part of the cost of goods sold in that case. And so we're going to jump then to, let's see if we can jump here. So let's adjust the beginning inventory. The beginning inventory is going to be this 1440000. So that's correct. Purchases, we're going to say is going to be, this is purchases including purchases and the cost of goods manufactured, and we're just going to be breaking out that between these two portions. Purchases then being the 838439. So I'm going to say, all right, let's take the 838439 and let's go back to our tax return, and we have in there, I'm going to say minus what we have right now, 681310. That's going to give us a difference. We're going to have to increase it by that 157,129. So I'm going to go in here and say, let's make another adjustment, 157,129, so we don't have to delete anything. And say, all right, so there is that. Then we're going to go to the, we're not going to put the depreciation because it's being pulled from the depreciation schedule. So this is going to be a component as well. These two, of course, making up that total purchases number here. That gives us the cost of goods sold available, cost of goods available for sale. And then we're going to have the ending inventory, which is the 1650000. So ending inventory, where is the ending? That's going to be 1650000, I believe. That was it, right? That was it, I'm pretty sure. Yep. Okay, let's see if that then pulls up to what we would think. Let's go to our form. Okay, we got the beginning inventory. Let's take a look. We're tying this out. We got the beginning inventory here. Check. We've got the purchases at the 838439, and then the depreciation at the 288585, and those two combined together come out to that 1,27024. Then, so that looks good, and then we have the total of those, the 2567024. So the 2567024 is the goods available for sale. Then we're subtracting out the ending inventory, the 1650000. That looks good, and that should give us the same number that we had before because we pulled it from the actual financial statements for cost of goods sold of the 917024. So that gives us the 917024. Now the next thing we would do is, of course, check if we are in balance. I'm going to go back to the tax return. I'm going to go back to the 1120 and say, okay, let's take a look at page 6. We started in balance before this process. Now we're out of balance. And now I'm going to go, well, something went wrong there. So what went wrong? If I go back to page 1 and I say, now we're going to have to dig into the detail. What's going on here? Well, the cost of goods sold calculation that we had here is now at the 917024. If I look at our tax trial balance up top, it should be at the 969,895. That's what we adjusted it to be, and that's because of that depreciation adjustment that we had for it. So that's going to be our difference. So now we got to go back and say, okay, so I picked up the wrong number here. Can we adjust the calculation and bring us back to balance? Now, the reason I want to point this out and work with this error is because note that being out of balance doesn't mean that I have no idea where to go back to, right? I was in balance before we started looking at cost of goods sold, and I know what threw us off. If we did this calculation as we went and we weren't in balance, we were trying to do 10 things at one time, then it would be more difficult to catch this error. I wouldn't be able to isolate it down to the fact that it was the cost of goods sold calculation, and you know, I'd be checking other types of things. So now I could just jump back and say, well, I know I was in balance before cost of goods sold, and then I would, be driven to this number for sure, check that number, and then I just know that there's something going on with the cost of goods sold calculation. And that's how you can basically isolate it down to picking up the wrong number here. Again, if you're doing cost of goods sold as you input the tax return, much more difficult to pinpoint that. And so I just want to point that out. So now we're going to adjust our calculation down here. I'm going to say, all right, the cost of goods sold bottom line number should be, I'm going to say, equal to the ending number here. We want it to be this 969,895 for tax purposes. And there's a difference there because we had an adjusting entry and we had a tax entry related to the difference in the depreciation. So now we're going to say, okay, now I got to adjust this number. So this number needs to be adjusted now. So I'm going to use the goal seek once again. I'm going to say, all right, let's go back to the goal seek. I'm going to put my cursor somewhere else off of the calculation. We're going to go to the data. We're going to go to the what if analysis in the forecasting tools. That's the group of forecasting tab data. And then I'm going to go to goal seek. And here's our little window for the goal seek. I want to say, hey, it would be nice, Excel, if you could make this number and set that cell, please, to be to the value, which I'll hard code, the 969895 by changing this number. And that's the calculation we want. And to do that, I need a formula down here. Hopefully that's a formula, but let's check it. And then I'll say, okay. And it couldn't do it because I pulled this number from up top. So let me do it again. This is going to be 969895, and I have to have a formula here that ties to the cells above it, which is going to be this minus this. Let's try it again. So this number's wrong, but I got the proper formula in it. We're in the data. We're going to go to the what if analysis, goal seek. And now we're going to ask Excel. Excel, we would really like if you would take this number, and I want you to change the value to the 969895 by adjusting the yellow item, and then say okay. And so there it does it. So there we have it. That looks good. All right. So now our bottom line number is correct. Now we're going to go back to the tax return and adjust this number. So we'll go back to our tax return. We're going to go to the 1125. We want to adjust the purchases number. So the purchases number, we're going to be adjusting here. It's this last piece. And notice this is nice that I didn't delete the numbers that were there before, because we still can see the adjustments we had there before. Now we have the 681310. And we want it to be, we're saying that the purchases, this is going to be broken out between the depreciation and the purchases again. So I'm going to say in purchases, I want that 891. So minus the 891310. And that's going to be a 210 adjustment. Again, this purchases down here is taking this number minus the depreciation, which is calculated by the software. So this number then I want to add to it 210000. Then we've got the depreciation, which should be carrying forward from the tax return. So that should be calculated correctly, this number. And those two numbers should add up then to that 1179895 here. That'll give us the cost of goods available. Ending inventory 1650. That should be the same. So we're down here. That's good. Let's see if the calculation does what we would expect. Beginning inventory stays the same. Purchases now at the 891310. So that makes sense. That ties out to this number. And then we have the depreciation, which did not change. That ties out to this number. Then we have the 2619895. That's going to be the 2619895 available. Ending inventory should not have changed. Bottom line number 969895. So that's going to give us the 969895. Let's see if that puts us back in balance. Back to the 1120, page 6, and then we're going to say, okay, are we back in balance? We are. Looks good. Let's just check our income numbers. They shouldn't have changed because all we did was add the detail for the cost of goods sold, but it's always good to go back through them, check them out. So we have then the 1674629. If we go back to our data, that should be the 1674629. That looks good. Then we have the 1669129. So that's going to be the 1669129. That looks good. Let's go then to page 6. Take a look at our M1 book value 14615. That's the 14615. That looks good. Let's take a look at the ending number in the M1. 1674629, and we have the 1674629. So we look good. Let's move forward.